Hello, traders. JD here with your Rational Trader Market Analysis Daily. In today's video, reviewing this week's mean reversion cash machine trades. What is a mean reversion cash machine trade? Well, very simply, what we're doing here is exploiting elevated option premiums around earnings season on stocks that are already trading at elevated levels, two standard deviations above the mean or higher. First up, Federal Express. Now, earlier, before Federal Express reported earnings after the market closed yesterday, we were able to put in a nice call writing trade on FedEx at $255 a share. You can see yesterday the stock was well above the mean here. And you can also see that $250, well, it doesn't even show up on the chart. It's that far above two standard deviations above the mean. So when Federal Express reported earnings that really were mixed, but included margins that did not meet expectations, and here's a key point: margins are so critical to rising stock prices. You want to see expanding margins. That's what gives you the pool of investors that chase a stock, pushing up, driving up prices to the highest valuations possible. So now, in the case of Federal Express, after its earnings report, those $255 options, now with the stock at $222 a share after today's trading, traded for a penny a contract. So prior to earnings being released, those $255 strike Friday expiration options, you could have wrote those contracts for just over $1 per contract. Today, with the crush after earnings, that contract could be bought back for a penny. Now, it's interesting to note what happened here. Look at where FedEx closed, right at the mean. I'm pounding the table on this, folks. Reversion to the mean. Reversion to the mean. Reversion to the mean is a very real effect in the market. It is something that happens time and time again. And the little secret here that we're exploiting with the mean reversion cash machine is that during earnings season, option prices are sky high because of implied volatility. The good news is that implied volatility is nowhere near where you are writing your contract on. In essence, that's one way to lower the risk of what is, generally speaking, a risky endeavor, writing a naked call option. Next up, Micron. Now, Micron today closed actually just below two standard deviations above the mean before its earnings report. And you could write a contract expiring on Friday at $142 strike price, again, for just about $1 per contract. Now, Micron's a little bit tricky. It's behaving like a AI stock. That scares me, okay? But what gave me comfort on this trade was the implied volatility being below, well below the $142 strike price. On top of that, just look at this 3-month chart on Micron. This was 3 months ago at the peak of the Liberation Day tariff tear. This was a $60 stock. It's more than doubled in value in less than 3 months. Now, that doesn't mean a stock can't continue to go higher. And in fact, it's these gains that gave me pause on this trade in advance of earnings because it's so red hot. The momentum here is off the charts. Is Micron an AI stock? Well, before AI became a thing, Micron was a commodity stock in the chip space, dealing with memory. There's nothing proprietary about what Micron does. Now, there may be supply issues that allow it temporarily to generate higher sales and profits, but one would think that that's already priced into the stock. But again, I'm not going to overanalyze this here. Very simple formula. Before earnings, stock trades two standard deviations above the mean, option premiums through the roof. In this case, not really through the roof though, up to, but higher than the implied volatility, mind you. The implied volatility suggested a 5% hike in the stock, and Micron, the 142 strike price on those options expiring Friday, is some 10 to 12% above today's closing price. So you have, again, the odds in your favor for that option to expire worthless. Micron reported earnings, and guess what the stock does? It moved higher, right in line with the implied volatility, right at in after hours trading so far, around 5% at the peak. It's come back some and trades, let me just look real quick, at 132 now, or just over 132, up 4%. So a little bit below what the implied volatility was, but nowhere near the 142 price that this option is going to expire at, or the strike price on the option that expires on Friday. So feel real good about this trade, even though earnings were fantastic. You got a AI Momo stock here. Little bit crazy to get into a name like this. But again, I just trust the analysis here. And it would appear that tomorrow, when Micron trades, I mean, even if the stock goes up 10%, double, more than double where it's trading in after hours, that's still below your strike price on an option that expires on Friday. You collect $1. That's the mean reversion cash machine at work. And finally, where is the stock trading in after hours? 132, 133. You see that red line here? You know what that is? That's two standard deviations above the mean. A stock trades 95% of the time between two standard deviations above the mean and two standard deviations below the mean. See how powerful this cash machine mean reversion approach can be. It's really quite spectacular. Looking to close two winners this week, and I am chomping at the bit for second quarter earnings season to begin in July. This is just a mere morsel of an appetizer in advance of what is going to be a field day, because in this market, so many stocks are trading two standard deviations. So many hot stocks are trading two standard deviations above the mean. And when options, or when those companies report earnings, their options are going to trade at sky high prices that we can scalp all day long. That's all I have for today. I'll be back tomorrow with another video. This is JD for The Rational Trader. Take care, everybody. Have a great day, and we'll see you all tomorrow.